Hello and welcome to our webinar series Krannert On. I'm Tim Newton, Director of External Relations for the Krannert School of Management. This webinar, titled How the Euro Affects the U.S., will focus on the euro and its impact on global markets and the worldwide economy. The webinar is being conducted by economics professor Jerry Lynch. Jerry is one of the most celebrated teachers at the Krannert School. He's been voted the Salgo Noren Award as top teacher in the master's program 5 times. He was named one of the 12 best teachers nationally in schools of business by Businessweek. He also has served in a variety of administrative roles at the Krannert School, most recently as interim dean. Jerry, thanks for joining us today. We'll go ahead and turn things over to you.
Well, thanks, Tim. There are a lot of concerns about what's going on in both the U.S. economy and the European economy today. We keep reading about the threat of what's going to happen if Greece defaults on its bonds and how that's going to set off contagion, word that's being applied today, throughout a number of the other countries in Europe. And so what I'd like to do today is talk a little bit about both the U.S. and European debt crisis, and I call it a debt crisis. Some may say it's not a crisis overall, but I think for both Europe and potentially for the United States, it might approach that. And what I'd kind of like to do today is talk a little bit about. Start off by talking about debt in general using U.S. examples. And once we've set up and talked about the United States, then go back and look at what's going on in Europe and kind of look at both the parallels and then the non-parallels. So let's start by talking about debt and how debt grows. Government, of course, raises tax revenue and the government spends. And the plan is that government spending is going to be equal to tax revenue and that we're going to have a balanced budget. But in reality, that almost never happens. A balanced budget is not going to happen just because we're talking about trillions of dollars of spending and trillions of dollars of tax revenue. So an exact balance is never going to work. But we would hope that we'd have some deficits, some surpluses over time. We had some surpluses in the late 90s, but in reality, we've run deficits almost continuously since the Great Depression going forward. So if the government spending is greater than tax revenue, where does it get the balance of the funds? Well, it doesn't just print money. We'll talk about how that's done in a few minutes. What the government does is it issues bonds and borrows. And probably many of our listeners out there have actually lent money to the government every time that you buy a U.S. Treasury bond, or even when you put money in a bank. The bank buys Treasury bonds. You are, in a sense, lending money to the government. Now, a couple of terms to clarify. Whatever the government does in a given year is a deficit. If the government spending is greater than tax revenue in a given year by, let's say, $1 trillion, as odd as that may sound, it's actually larger than that this year, then that is $1 trillion deficit in that year. What that does is it adds to the debt. The debt is a stock. So the deficit is a flow, the debt is a stock. And if we run $1 trillion deficit, then the debt goes up by $1 trillion. And the national debt today is, we have a couple of different measures of it, but by one measure at least, it's at about 100% of gross domestic product. Because that's what we'd like to do with this, is not just talk about the absolute numbers. $1 trillion in deficit and an $1 trillion addition to the debt is certainly scary, but we scale that by looking at gross domestic product. Gross domestic product for the United States is about $15 trillion or so. So if we run a deficit this year of about $1.4 trillion, which numbers aren't completely in yet, but that's what it looks like it's going to be for 2011, then the deficit to GDP ratio was about 10%. And currently the debt to GDP ratio in the United States is about 100%. And a concern that we have about that is that for both the United States and for Europe, let's take Europe as a whole, although not all the countries are contributors here, the debt to GDP ratio is growing. And to kind of bring this down to the household, if you were to find out that Ross Perot had more debt than you, that's not really a concern because he has a lot more income. And so you look at a debt to income ratio. That's what we do when we look at a debt to GDP ratio. And even as we look at that, we find out that debt is growing. Now, this past summer, there was a super committee that was to look at the problem of the deficit and the debt. And that was because the United States was bumping against its debt ceiling. And you may remember all of this from last summer. Was government going to have to shut down and things like that? Let's talk a little bit about this. Some number of years ago, and to tell you the truth, I think it was 1917, the government established a debt ceiling and said that the national debt could not go above a certain amount. That was established in 1917 at $11.5 billion. The debt ceiling has been raised 74 times since 1962, and it was at about $14.3 trillion when it was raised last summer. Actually, the United States and Denmark are the only two countries that have a debt ceiling. The rest of the countries don't really worry about it, and in some sense, you wonder if the United States is really worrying about it because every time we come up against the debt ceiling, we raise it. We don't actually have a deficit ceiling, how much the deficit can be as a percentage of gross domestic product in a given year, but we just have a debt ceiling. And as you can see by looking at the PowerPoint, it really doesn't matter whether it's a Republican or a Democrat in charge. We continue to spend more than we have than we've earned in tax revenue, and we continue to have that debt build up over time. And so that's one of the things that really brought about a concern about how large the debt was. And of course, as we negotiated on the debt ceiling last summer, there was such divisiveness because the Republicans wanted to control spending and not increase taxes. That's what they said. The Democrats wanted to increase taxes. They didn't say they didn't want to control spending, but that's kind of where we were on both sides of the House there. Let's look in a sense at how this has grown over time. And you notice two lines here. You see a dark line and a red line, the gross debt and the public debt. The difference there, and this is why when I was talking earlier, I said there are a couple different measures of the debt to GDP ratio. Whenever the government runs a deficit and sells bonds, the Social Security Administration buys some of those bonds. Currently, for all of our talk about the woes of Social Security, currently Social Security takes in more in tax revenue than it pays out in a given year. And so with that surplus, what does it do? It buys government bonds. We could get into a whole different discussion and have for a long time in the past and keep on going on with that as to whether or not that's actually going to pay off in the future. But let's not worry about that right now. The difference between the gross debt and the public debt is that the gross debt includes that debt that is held by the Social Security Administration. The public debt does not. And so when you look at the bottom line here, at the bottom half of the graph, I should say, you'll see debt as a fraction of gross domestic product. If you're looking at the gross debt, it's at about 100%. And if you're looking at just the publicly held debt, then it's down at about 80% or so. But I think the thing to think of with both of those is not so much where it is, but where it's going. And you can see that the debt to GDP ratio, as I mentioned earlier, is rising. A little historical perspective on that. At the end of World War II, the debt to GDP ratio was above 120%, and through years of economic growth, we were able to get that debt to GDP ratio down. It actually bottomed out at about 40% in 1980, and then deficits during the Reagan years, the Bush years, not too much during the Clinton years, but certainly during the Obama years. The debt to GDP ratio has climbed over time. Okay. One of the concerns that we had about raising, whether or not we were going to raise the debt ceiling, was would the United States actually default on its bonds? And I thought that was a kind of an unnecessary concern, because it didn't mean that we couldn't take the current bonds that were existing and roll them over from one year to the next. It just meant that we couldn't continue to finance increased government spending by selling more bonds. So there was a lot of talk about the There was a lot of talk about if we don't raise the debt ceiling, then the government's going to default on debt. That was really not a real concern. The debt that was extant, we can always issue more bonds and roll that debt over because the debt to GDP ratio was not going to grow. This shows a little bit more recent trend of what's gone on with receipts and expenditures that you could see at the end of the 90s, early 2000. Receipts were just above expenditures at that time at about $3 trillion or so. Now receipts are up to $4 trillion, but expenditures are up to $5.5 trillion. And so that's why, actually 5.4, that's why we had a $1.4 trillion deficit in 2010, which was close to 10% of gross domestic product in that year. And this is just looking at over time the deficit to GDP ratio. Once again, it shows in the late 90s and early 2000. You can see the blue line is above the red line. Those are the surpluses that we ran through those years. But you can see once again that at 16% and 25%, we're at about a 9% deficit to GDP ratio, which means that the debt to GDP ratio is growing pretty dramatically over time. Okay? So the government's running these huge deficits. Who is funding these deficits? And the question really is, who is buying the bonds that the government is selling? Well, those bonds are actually bought by, I'm going to say, three different groups of people. You could break it down to more than that, but I'm going to hold it to three different groups of people. Those bonds are purchased by U.S. citizens, and in order to do that, U.S. citizens have to save. They have to spend less than they earn and then take some of that money and put that into U.S. savings bonds. And of course, while the savings rate for Americans is rising for a long period of time, Americans were not saving very much, so the deficit was not being funded by U.S. citizens. A lot of that deficit was being funded by foreigners, and in particular by China. The Chinese, the oil-producing countries, Japan, Germany also, all of those nationalities like to buy U.S. Treasury bonds. It's a safe investment. It's going to hold its value over time. And so to a certain extent, that's made it very easy for us, for the United States, to run deficits because we're actually borrowing that money from abroad. We're not competing for funds necessarily domestically, but we're borrowing from abroad. So what do we have? Part of that deficit is funded by U.S. citizens when they save. Part of that deficit is funded by foreigners. And part of that deficit, and this is kind of a controversial part, is funded by the Federal Reserve. And when the Federal Reserve buys U.S. government debt, they increase the rate of growth of the money supply. To get into how that works would take a kind of a long and some would say boring elucidation of what the balance sheet of the Federal Reserve looks like. And rather than going into that, I'm going to ask you to just trust me and understand that when the Fed buys U.S. government debt, they increase the rate of growth of the money supply. Now, what we expect that to do is that as they buy those bonds, as they fund that deficit, that keeps interest rates from rising. And the more that the Fed buys the bonds, the less that we think interest rates will rise because of a high deficit. That's what quantitative easing is all about. Quantitative easing 1, and now what's known as quantitative easing 2, the second phase of all of that. The government has been funding the deficit, the Federal Reserve has been funding the deficit by buying government bonds, increasing the monetary base, and ultimately increasing the rate of growth of the money supply. And one of our concerns is that eventually that money's going to work its way through the economy, and it might cause inflation. As we've talked about QE2 over the last few months, the Fed has tried to focus on long-term bonds. That means that they're going to, as they buy government debt, they're going to buy more long-term bonds, trying to keep that interest rate low. The idea of that is that if the interest rate on long-term bonds is low enough, then banks, instead of holding in their loan portfolio government bonds, if the return on those are low enough, maybe they'll start making loans to private businesses and try to get the economy going again. So one of the concerns that we have then is that as the United States has large debt and deficits, and that as the Federal Reserve funds those deficits by printing more money, we're concerned that there might be more inflation in the future. A second concern really doesn't necessarily have to do with who funds that, but the interest payments that are going to come due on that debt. Interest payments on the debt are paid out of tax revenue, and that's a good thing. That's fiscally prudent. If you found out that we were making interest payments on the debt by issuing more debt, then that's a slippery slope that we're never going to get out of. So we make interest payments on the debt out of tax revenue. The question that we have is, how much of our tax revenue is going to go to simply make interest payments on the debt? How much we have to pay in interest on the debt depends upon two things: how large the debt is, and then what the level of interest is that we're financing that debt at. The debt to GDP ratio is growing, and so interest cost as a percent of tax revenue should be growing, except that we have historically low interest rates. 3-month Treasury bills are paying like 3/16 of a percentage point in interest. Longer term bonds are paying 1.5%. And the problem as we foresee it is this: we've issued that debt. We're not going to retire that debt. I mean, we did have surpluses in the late 90s for a couple of years, but historically, we haven't retired that debt. We just roll that debt over. And then what happens then is that as interest rates start to rise to their historical levels, the interest rate that we're paying on this burgeoning debt is going to rise, and interest payments as a percent of tax revenue are going to rise. What could that go to? Well, this is kind of a, you might think this is a scare tactic that you're seeing here. Let me explain first what's on the bars. Then we'll talk about what the bars are predicting for the future, and then we'll talk about what the source of that is. This is government spending over time. You can see at the bottom we've got Social Security, then Medicare, then Medicaid, then net interest. All of those are mandatory payments. I mean, we've got a commitment on Social Security, Medicare, Medicaid, and interest payments on the debt. We are not going to say to bondholders, we're not going to pay your interest. The white part at the top of those bars is other government programs. That includes defense, money that the government may want to spend on education, and things like that. The dotted line is government revenue as a percentage of gross domestic product. And now this line projecting out, quite frankly, is kind of looking at a historical average. You can see from 2010 forward that dotted line really does not rise or fall over time. That's because we don't know what revenue as a percent of gross domestic product is going to be for the government. Depends on so many things. But we do have a good idea, looking at demographics, what Social Security, Medicare, Medicaid, and then especially net interest on the debt are going to cost us. And you can see that while net interest on the debt in 2010 is not very large, that's going to continue to rise over time, because as we continue to run deficits, as we build up the debt to GDP ratio, and as interest rates rise, that's really going to start to grow. And you can see that sometime between 2030 and 2040, mandatory spending will exceed government revenues. That means that all of that other stuff that we like to do, like defense, building roads, dams, funding education, the federal portion of funding education, all of that's going to have to be deficit financed. Now, this is not some scare group that has put this together. If you've looked in the bottom right-hand corner, you see that this is from the Government Accounting Office. So this is the government making a projection about what's going to happen to debts and deficits over time. And so we have a couple of concerns in the United States, and the only thing that we can take solace in is that the concerns in the United States may not be as large as the concerns in Europe today. We've talked about debts, deficits, and so forth for the United States. Let's look now to see what's going on in Europe. And there are many similarities, but there are also some differences. The similarities are this. European countries run a deficit whenever the government spends more than it takes in tax revenue. Two sides of that equation. How willing is the government to tax? And then how much has the government promised to its citizens? Another similarity is that individuals have to save money and buy those bonds. And the third similarity is that many of those bonds can be financed by outside of the country. And in fact, it's even easier in some sense in the European Union for countries to buy bonds of other countries. For example, for Germany to buy a bond from Greece or Spain or Portugal or Italy, which they've done in the past and may not be so crazy about doing in the future. So those are the similarities. Here's the big difference. In the United States, when the government runs a deficit, the central bank can fund that by buying those bonds. And to a certain extent, that can happen in Europe also, but it becomes a little bit more complex. When Europe went to a single currency, the euro, it needed a single central bank. That means that there is a single rate of growth of the money supply for all of Europe. Countries that run high deficits might like to see the central bank financing those deficits by increasing the rate of growth of the money supply, but now that offends countries that are not running high deficits because those countries may be experiencing inflation because some other country has had a high deficit. And let's not talk in nondescript third-party terms here. In particular, right now, the Germans, who are the savers in much of Europe, and I'm using Germany as an example of the saving country, is concerned about the fact that they're going to have to fund the profligate spending of Greece. And I'm using Greece as a spending country as the example there. And that's a pretty good example because Greece has been running fairly large deficits over time. When Europe formed a single central bank, they had a single currency over a large geographic area. And back in the early 1960s, an economist at Columbia University named Robert Mundell did some path-breaking research on optimum currency areas. He eventually got the Nobel Prize for that. And he says there are two things that are important for a geographic area to operate with a single currency and a single rate of growth of the money supply. Similar macroeconomic shocks and free labor mobility. Similar shocks means that everybody wants to have the rate of growth of money supply the same because their economies are growing or shrinking at the same rate. That doesn't happen in the United States. Some states grow faster than other states, but it certainly doesn't happen in Europe because we're seeing Germany with a fairly robust economy right now and the Mediterranean countries are not. The benefit that the United States has that Europe does not is that we have relatively free labor mobility. People move across state lines to find jobs fairly readily and easily. That is not the case in Europe today, both by kind of history and also because, of course, the language problem still exists in Europe. Because of wanting similar macroeconomic shocks, to be admitted to the euro, countries were supposed to meet certain criteria. There were inflation criteria, interest rate criteria, and things like that. But let's talk about the deficit and debt criteria. In order to be admitted into the euro, you were supposed to have a deficit to GDP ratio of 3%. And many of the countries started to raise tax revenue and control spending as the vote approached in 1998 so that their deficit to GDP ratio was 3%. The debt to GDP ratio was supposed to be at 65%. At the time, in 1998, when people were admitted to the euro, Greece was at 100%. And actually, Greece was not initially admitted into the euro. It was not allowed to use the euro, but they kept petitioning to be allowed into the fraternity. After all, the Greeks started fraternities, so why shouldn't they be a part of it, right? And so Greece was admitted, even though at the date of admission, they violated the criteria to be in when their debt to GDP ratio was 100%. Right now, it's over 150%. And of course, they're not alone. We talk about the pigs, Portugal, Italy, Greece, Spain. I guess we should spell pig with two I's because Ireland's in there also. And so the problem that we have is that we have a number of countries that are running huge deficits. They cannot depend upon the central bank to fund those deficits. So the only way that they can pay those bonds off is by raising money on their own, which would be increasing tax revenue and hopefully decreasing spending. Okay. How did all of this come to bear? In the summer of 2010, Greece needed to roll over a lot of short-term debt. And at the time, they were violating the conditions that I've included on this slide. They were way above the 3% deficit to GDP ratio. They were way above the 65% debt to GDP ratio. And the European Central Bank was not going to buy their bonds. So as Greece was rolling over those bonds, people realized that the only way Greece was going to be able to pay off that debt in the future was if they increased taxes or cut spending. And people had little confidence that Greece was going to be willing to be able to do that. And of course, this is getting out of sync a little bit with time, but what have we seen since that time? Greece has proposed increasing taxes. Greece has proposed cutting government spending, and the Greek people are demonstrating in the street because they feel, not unlike how Americans would feel, they feel like they had a promise made to them for what their pension was going to be, just like we believe we're going to have Social Security paid to us, and if the government says we're broke, we can't pay that, then people are up in arms about it. So in the summer of 2010, when Greece needed to roll over that short-term debt and the private market wouldn't buy it, what Greece did is it went to the other European countries, and in particular, it went to Germany. And it said to Germany, look, you're rich. We've overspent. Why don't you go ahead and buy this debt from us, and we promise we'll change our evil ways in the future, and we'll be able to pay this debt off. Well, Germany did not want to do it. And of course, one of the things that had happened is that many of the banks in Germany, in France, in the other countries had purchased that European debt in the past. And so now we're kind of stuck in a dilemma. If Greece does default on their debt, then a lot of private banks throughout Europe are going to be in trouble because a large portion of the assets they hold on the asset side of their balance sheet will simply go away. Assets will be less than liabilities. The banks will be running the risk of default. So we continue to put pressure on Germany, hoping that the German government will take its vast resources and buy up some of that Greek debt.
The German people have been opposed to it. I was actually teaching an exec ed class in Germany in 2010, and the concern among the Germans there was this. People in Greece retire with full pension, state guaranteed pension at age 55. We've got to work to 65. We're going to buy their discredited debt so that those people can retire early. We just don't want to do it. And so Germany did not want to get involved in it. There is a financial independent facility. I can't remember exactly what the acronym is for it. And what's happening here is that a bunch of the countries all agreed that they would put money into a pool, and then they would buy that debt in case somebody was about to default on the debt. And I'll talk in a minute about why they might wanted to do that. But here's the concern that you have here. Suppose you're a student living in an apartment and there are 4 or 5 people there, and people say, you know, some weeks I earn more than I spend, and some weeks I spend more than I earn. And why don't we just all throw money into a bowl every week? And some weeks you'll throw money in and some weeks you'll take money out. And that seems like a nice kind of congenial, socialistic type of thing to do. The problem is, if some people are always putting in and others are always taking out, there are going to be some disagreements. And that's what Germany in particular was concerned about, is if we all start to pool money together and buy debt from the countries that can't make good on that debt, we're always going to be paying in. Greece, Portugal, Italy, Spain, Ireland, they're always going to be taking out. Right now, then, it depends on the ability of the country issuing the debt to either raise tax revenue or decrease spending so they can make good on that debt. Recently, just in the last week or so, Standard & Poor's once again has started to downgrade European debt, and now the downgrade makes sense because the European Central Bank has not indicated that it's going to be willing to monetize the debt of all of those countries, and the individual countries are not real crazy about buying that debt, and there have been a lot of disagreements on the group that has kind of come together on how they're going to buy that debt. And so it's going to depend upon the individual country to be able to raise enough tax revenue and, of course, decrease spending, because they can't keep adding to their debt by running deficits to pay that debt off. And that's why we have this situation here. Germany can go out into the market right now and borrow at about 1.87%. Italy, which is part of the same European Union, has to pay 7.14%, 5.25 percentage points above that. Why is that? Because the market doesn't think that Italy is going to get a handle on its future deficits and adding to its debt and be able to pay that off over time. And of course, Standard & Poor's downgraded them, but in this particular instance, it kind of made sense. And Italy's not alone. We pick Italy because Italy probably has more debt out there, being a larger economy, than actually a lot of the other countries do. Greece is in trouble too, though. Greece has about 106 billion euros worth of debt that it's going to have to refinance in the next 3 years or so. And that means that it's going to be rolling over that debt, and somebody is going to have to buy that debt. And if we don't have the European Central Bank buying it, if we don't have Germany and France and the other countries that are fiscally sound buying it, and if we don't have the amalgam of the countries coming together buying it, then Greece is going to default on its debt. Now, Standard & Poor's and Fitch, that's also a rating agency, they have also been concerned about France and particularly Germany. And you think, why should we be concerned about Germany's ability to raise debt? Let me back up a little bit. About a month or so ago, Germany was out rolling over debt. It issued bonds, and they weren't fully subscribed. People didn't want to buy them all at the time they came out. Why not? Guilt by association here. I think euro-denominated debts are in a sense tainted now. Anybody who buys debt, whether it's from Germany, France, Italy, Ireland, any of those countries, they are holding an asset that is denominated in euros. We don't know if the euro is going to stay around, but even if it does stay around, if the value of the euro falls and you hold a German-issued bond, then the value of your asset falls. Anytime you invest in an international asset, you have two risks. You have the risk of whether or not the asset itself is going to perform, and then you have the exchange rate risk. I don't think people think that there's a risk that Germany's not going to be able to pay off its debts, but they are concerned that it's going to pay off its debts in euros, and the value of the euro may fall over time. So if you're holding euro-denominated assets, you're holding assets that have fallen in value. Another thing is that German banks, once they start to buy that, they have suspect debt on their balance sheet. And we've seen what's happened in the United States, and it could carry over to Europe too. If the assets on your balance sheet are not performing, if people are not paying back their loans, and that's what happened, of course, in the housing crisis in the United States, then you have to retrench on the amount of lending that you do overall. This is really getting in depth, but the Basel I and Basel II requirements, which talk about how much capital banks have to hold, what they have counted as capital in the past is both cash that banks hold, but also government-issued debt, because everybody thought government-issued debt was safe. Now, if that government-issued debt is not safe, then banks don't have enough capital to satisfy the Basel I Accords, and so what are they going to have to do to substitute for holding government debt? They're going to have to hold more cash, and it means that they're not going to lend as much. And so here are some of the consequences. Haircuts, people taking haircuts, and then the famous bumper sticker you see, WWCD, what would China do? Okay? Private investors in Greek bonds have already taken a 50% haircut. That means that if you gave Greece $1,000 in euros and you're holding a $1,000 Greek-denominated bond, then you now have 500 euros in Greek-denominated bonds. I mean, that's a kind of restructuring that lenders do all the time. They think, well, I'm not going to get back 100%, but if I forgive some of that debt, will you pay me back? And so Greece is already, the people who bought Greek bonds have already taken a haircut on that, 50%. That's pretty serious. That means that all of those banks that own that Greek debt, it's half of what they thought it was going to be. Here's something I'm projecting for the future. That means any future debt that Greece sells, they're not going to sell it in the private market. The private market has got to be finished with Greek debt. Who's going to lend money to Greece when they've already taken that 50% haircut? So somehow that's going to have to come from governments who are kind of willing to join together and bail Greece out over time. And we're just not seeing a whole lot of that. We have seen countries in the past who have defaulted on debt. Argentina did back in the mid-90s or so. They just said, you know, all of those people, all of you guys who own Argentine debt, it's no good anymore. And of course, it's very difficult then for the country to go back out and borrow. One of the biggest lenders in international markets is China. And what I think this means is that the United States is going to continue to be able to keep borrowing from China, which means that China is going to continue to hold more U.S. debt. What's interesting going back is that back in August, when Standard & Poor's downgraded U.S. debt, you would expect that a downgrade, saying that that debt is more risky, would push interest rates up on U.S. debt. But in reality, you only have to be better than the other people. And because Europe was in such a crisis at that time, even though Standard & Poor's has downgraded U.S. debt, the yields that the Treasury had to pay to issue debt went down over time. So the United States might not look very good, but if they look better than Europe, then China's going to keep coming to the United States. And here's the impact that I think it's going to have on the world economy as a whole. If European banks get frozen up in their ability to lend, and it's looking very much like that's going to be the situation, there's going to be very slow growth in Europe. The European Central Bank just a couple of days ago met. They decided not to push interest rates down any further. They're already at 1% for short-term rates, so I'm not sure how much lower interest rates are going to spur lending over time. But they're not going to cut those interest rates, and I think Europe is just girding itself for very slow growth. What impact does that have on the United States? The United States exports, I should say, the United States exports almost 10 to 12% of gross domestic product. One out of every 9 jobs, let's say, in the United States, depends upon foreigners buying goods produced in the United States. And one of our big markets is Europe. And at a time when the United States is trying to come out of a downturn, we really don't need one of our trading partners, Europe, to be in a downturn also. And so we kind of go back to the start. What are the parallels between what's going on in Europe and what's going on in the United States? Both countries have a large amount of both the country of the United States and the continent of Europe have a large amount of publicly issued debt. I think one of the biggest differences is that the Federal Reserve can always buy that debt in the United States. The European Central Bank is not inclined to do so, and one of the reasons they're not inclined to do so is just the huge political difference that takes place there. When the Federal Reserve buys U.S. issued debt, you don't see people in Illinois complaining about the fact that people in Indiana are being bailed out because we're all the same country. If the ECB starts to buy Greek and Italian and Spanish and Portuguese bonds, you're going to see the Germans and the French complaining about the fact that Germans and French are bailing out those other countries. And so I wish I could sit here today at the beginning of 2012 and give you an optimistic outlook for the United States. For Europe. The U.S. economy is going to recover from where it was last year. I think the U.S. economy will be stronger than it was in 2011, but it would have a chance for a lot more growth if things were going better in Europe. But they're not. And so if you don't have completely glazed over eyes from all of that information, I'll take some questions now. Tim, do you have some?
Not necessarily. Yes, we do. Jerry, thank you very much for your presentation. You would think a trained professional would know when to turn the microphone on. I will learn that before it's all said and done. We do have a couple of questions, and I want to start first of all with one of the things you talked about in the near the end. We were talking about basically the fraternity that created the euro. Let me look at that from both sides and ask you, first of all, why don't Greece and Italy and some of the countries that are really struggling leave the fraternity and start their own bank, country-centric bank or monetary system? And on the other hand, why aren't the other countries kicking them out of the fraternity?
Well, that's a great question, and certainly it's something that has come up. Back in the late 90s when this started, the German people were really not very happy about going to a euro, even though the German government kind of led it. The German people weren't, because they were giving up their much beloved Deutschmark, which had been a nice and stable currency for a long period of time. Extricating ourselves, we'll include ourselves as a global community here, extricating ourselves from the euro would be a difficult but not impossible task to do. And one of the things that could happen is all of the countries could go back to their old currency. We could go back to the Italian lira, and it could just start off by saying it's 1 lira to the euro, and then over time we would find out what would happen to that exchange rate. And my guess is that the value of the lira relative to, let's say, whatever Germany has would drop over time. I think the fact that Germany and France were so strong in supporting the movement into the euro just 13 scant years ago would lead them to not want to be the ones that suggest that the other countries leave the euro. But my guess would be that if Greece and Italy, Spain and Portugal said, you know what, this isn't working out for us, we want to leave, they probably wouldn't be that unhappy about it. It's kind of like you have an employee that you don't really want to get rid of, and they come in and say, I think I'm ready to leave. Sometimes you're pretty happy about that. As an example of why that might work, back in the early 1990s, Great Britain was participating in the euro, and they were taking the steps, take a long time to explain it, but they were taking the steps that were going to lead to them being a part of the European Union and using the euro, and they decided in 1992 to drop out. And certainly the healthiest economy of all of those over there right now is Great Britain, because they determined their own fate. Right now, Germany can't control its own monetary policy. France can't control its own monetary policy. There is one monetary policy for all of Europe, and what Germany wants to do is different than what Greece and Italy want to do, and that's really kind of holding them back. Robert Barrow, Harvard economist, had an article in the Wall Street Journal just earlier this week where he talked about the path for countries leaving the euro and going back to their own individual currencies. And I'll say that Martin Feldstein, another Harvard economist, back in the late 90s, was very suspicious of whether or not the euro would work at that time. And so some people think this is the great experiment and it's time to abandon the euro. Maybe the great experiment needs to move to a pact where we have countries that actually experience similar macroeconomic shocks, and they're the ones who should be in the euro. And in a final point to a long answer, there have been a lot of Eastern European countries that have wanted to come in the euro, and people have balked at letting them in. They're not asking anymore. They really don't want to be a part. Right now, and maybe for the next 2-3 years until all of this gets worked out, being a part of the euro is going to be more of a hindrance than it is to a help for a lot of those economies.
You mentioned late in the presentation that countries like France and Germany have been reluctant to step in and help the countries out, such as Greece and Italy. Does the United States have either the ability or the incentive to step in there and try and help some of those countries?
Ability, yes. Incentive, not a lot. Now, the United States doesn't want to do this directly. They don't want to go over and buy that debt issued by Greece or Italy or so forth, because then once again it looks like if they buy Greek debt, then are they going to buy Italian, Portuguese, Spanish, and Irish debt? Or are they just going to buy Greek debt? And so instead, what the United States has done is they gave money to the International Monetary Fund. And the International Monetary Fund, as a multilateral lender, has the capability of then making the decision. So the U.S. is kind of helping out the situation by doing that, but they're not making the individual political choices. And I don't think we're going to see that. I don't think we're going to see the United States in any bilateral moves buying one country's debt. In truth, the amount of money that we put into the International Monetary Fund, it was, and I can't give you the exact number, but it was more of a gesture than it was something that's really going to solve the problem.
I think going back earlier in the presentation, you talked about the fact that foreigners held about 50% of the publicly held debt for the United States, and China is the leader in that category with $1.3 trillion. Is there any concern about any of the countries that are emerging in that area and any instability there and the problems that that may cause?
Well, yes. I mean, first of all, there is always concern that people may not want to hold that debt any longer. China has a particular problem because by them buying our debt, they buy dollars, they bid up the value of the dollar, bid down the price of the yuan, and that helps their trade balance. For the others, other countries that are buying our debt, they're looking for long-term safe debt. For the time being, it's still the safest thing out there. International investors don't want to be out there where the wild things are. They want to come home to where someone loves them best of all. And for right now, that tends to be the United States. But it's certainly plausible that at some point in the near future, they may be less inclined to hold that U.S. debt. If they are, then that means the United States is going to have to pay higher interest rates in order to sell that debt, and then that whole question about interest expense as a percentage of tax revenue rears its ugly head again.
Yeah. As everyone knows, we're deep into another presidential election now. I'm going to put you in a different role. You've had an award-winning run here as a professor and a great administrator, but now I'm going to make you a political advisor. If you're out advising candidates on how they're selling the debt to the public, what their stance should be, what are you advising them?
Well, I think that somebody has to get serious about controlling spending overall. you look at the, let's talk about the tax side first. Taxes as a percentage of gross domestic product, 16, 17% now. We kind of have a historical benchmark at being at 19 or 20%. I think as the economy recovers, we're probably going to get close to that, get close to 19 or 20%. The question is, should we increase tax rates in order to do that? That's always a tough question, because will those tax rates really generate more higher tax rates, generate more tax revenue in the future? And the answer is probably yes. So I think that you have to, if you're running for office, you've got to look for a common central ground. And so anybody running is going to have to be willing to say that we need to increase taxes in some way, shape, or form. But in reality, what we need to do is reduce the amount of spending that we're engaged in. As we emerge from the recession, some of that spending is going to decline also. I think the size of the deficit being 10%, if we had a good and healthy economy, a lot of that would go away. That's the cyclical deficit. What's left is a structural deficit, and I still think the structural deficit is fairly high, and we need to think about entitlement payments like Social Security, Medicare, Medicaid, and somehow get a handle on that. That's a nice politician's answer. How to get a handle on that, I don't really have that, but if I were standing in front of a crowd and said we have to get a handle on that, I bet I would get polite applause, so I'm going to stop with that one.
All right, let me finish with one more question. I will let you paint an optimistic viewpoint and a pessimistic viewpoint in terms of the European debt and what's going on there. Best case scenario, worst case scenario.
Well, the best case scenario in the short run is really not very bright. I just don't think that that Europe has a lot of capability right now. Their financial markets are so muddled. I don't think they have a lot of capability to have strong growth in the next year and a half, or so forth. The United States is kind of moving back to a recovery. Part of the problem we had is we were hugely overbuilt in housing, and we had so much commercial real estate, and not having built many houses or much commercial real estate in the last couple of years or so, we're catching up to that. So I think the United States is kind of poised for some growth in the future. I do think that 2012 will be a better year than 2011, but we can't depend on Europe to help us out much along that path. It's going to have to be a recovery we take on our own. And so where is the recovery going to come from? Actually, some of the economies that are growing now are, of course, the Southeast Asian economies, and the African economies are finally starting to get their legs under them and grow a little bit. And the United States is going to have to seek more economic cooperation with some of our non-European trading partners in order to accelerate the growth that we hope will come.
Well, Jerry, that's all the time we have today. Thanks again for a great presentation. We appreciate all the work you do for the Krannert School.
Thank you, Tim.
Please check the Krannert website at www.krannert.purdue.edu for future webinars. You can also follow the school on Twitter at Purdue Krannert. That's one word, Purdue Krannert. For Jerry Lynch, I'm Tim Newton. Thank you for tuning in.